Hey guys, super happy to be here once again. And today I'm very, very excited because I do have Robert Tratt here, and I'm excited, because before the initiation of every conversation I have here on the show, because we're going to explore some very, very relevant information about the financial markets and about Robert's perspective, like over the traditional markets and family office and portfolio management entirely. It is a very, very exciting starting point for the conversation itself. So I will let the guest to introduce himself. So Robert, it is a pleasure of mine to have you here on our show. And as I said, I'm very, very excited before every recording session, but this one is really excites me because we're going to speak on different but not different topics that I'm usually speaking here at this stage. And yeah, very happy opportunity. And thank you for coming.
Thank you for having me. I'm delighted to be here and to take part and hopefully share some of my knowledge and help some people out along the way.
Brilliant, brilliant. So yeah, before we start, I would love if you can introduce yourself to your audience, so we'll be able to meet you.
Yeah, so I'm Rob Tratt. I'm based in London and I've been involved in the financial markets now for just over 25 years. Having
Just
graduated,
yesterday.
yeah, exactly. No significant time at all. I studied university economics. Knew I wanted to work in the financial markets. Didn't know exactly what I wanted to do. After a couple of steps closer to the market, realized I wanted to become a trader and make the trading decisions for myself. One of the key reasons behind that was reading the original Market Wizards books and just being enthralled by the markets and the opportunities that were there and the ability to take on that sort of mental challenge to understand all these different drivers and it being a competitive way of trying to make a living. And really, the first step in that for me was when I got a job as a junior trader with a prop firm back in 2001. I was part of their first group of screen-based traders to trade futures. They were a one of the largest groups of traders in on the life exchange. So as that transitioned off of the trading floor onto screens, they brought in I think four, five, six graduates to be part of their first sort of cohort to trade on the futures markets. And there wasn't much of a training plan at the time. There was no simulator, so I was trading live from I think my second day, and it was the day after the first emergency rate cut in January of 2001. So it was a pretty wild time in the markets, a lot of volatility, and effectively I was just told find a way to make money. So I probably lost money for 3 months whilst I was getting used to the markets, working out what was going on, getting exposed to different markets until I finally found, my feet effectively, and found a way that I could be consistently profitable. And that was by looking at the intermarket relationships between various different European equity index futures. So I ended up specializing in trading the FTSE index futures against the Eurostox futures. And there were quite a lot of inefficiencies back then where around open times, closes, and where the relationship should be at different times. And if you were savvy enough, you could take advantage of those things and sort of profit pretty consistently, as well as trading off of news flow and things like that. So I ended up building up a pretty consistent sort of track record there. And then after a year, I left to go and be backed by a private individual. And then I joined his group of traders and as a fully self-employed trader, and that was in 2002. And yeah, just to gradually evolve that style of trading from 2002 up until sort of 2008. It was pretty much all discretionary based. And I eventually, from sort of 2008 onwards, turned that into a much more systematic way, automating some of the edge that I had. And that's where I sort of took my trading to sort of a significantly higher level in performance. So doing the research, quantifying the edge, automating that, and then taking that same approach and branching out into different markets. So I ended up having the same approach, trading European government bond futures and the relationship between different parts of the yield curve there. And that was the case until probably 2012, 2013, and those sort of edges started to deteriorate quite significantly. Where I was trading around, sort of trading around the opens, where the each individual market has an auction process, and the weight of each order in each market dictates what the price that the market's open at. I could have a view where they were, those two markets which were opening, was out of line where I thought it would be, and I would take part in that auction process to take the counter view and to trade them the mean reversion effectively back to where I thought it should be. But if the view I had was that most of these sort of flows were driven, by institutional sort of prop trading, and coming out of, global financial crisis, a lot of that sort of prop trading side was diminishing. There was a lot less volatility. We're also getting into that sort of zero interest rate environment with all the major central banks. So rate volatility was significantly compressed, and at that period, then my day-to-day bread and butter earnings had sort of kind of diminished a little bit. But on the flip side, from probably 2005, six onwards, I'd started building tactical based strategies, technical analysis, using those fairly sort of simplistic approaches, and then that's built those up across a wide range of markets, and increased the complexity of the ideas and that I was and the features and factors that I was trying to exploit. And I built up a portfolio of strategies there that had become, pretty consistent and successful. And I started to trade sort of obviously my own money, but some family money as well, which went well. And then where we're going back now, 2013, 14, I had the chance to partner with someone to launch a small London-based CTA. We'd been promised a large amount of, I guess, effectively seed investment to trade these strategies and to build a firm with. But unfortunately, 2 years later, we hadn't seen any of that money. So we were still very small AUM, family, friends, and connections that we knew, and that wasn't viable to continue. And then I moved on to join a larger prop firm to trade some of these strategies, but also predominantly to work on building some more higher frequency, but actually in the sort of that faster end of medium frequency strategies, in a fully automated way to trade mean reversion within government bond futures across two different universes. So I won't disclose exactly what I was doing there, but the approach I built worked phenomenally well for a couple of year period that I was with them. Sharpe ratio during that time of over 4, and I had a Sharpe ratio, I think, of what, 1.5 on the sort of lower frequency technical based strategies. And then I moved on to join a Swiss hedge fund, small hedge fund that was active in the short term trading space. A few day holding period was a sweet spot there, which was kind of where I specialized um, in my technical based strategies. So I worked with them for 4 or 5 years, building out portfolio strategies. Whereas I think,
As a CIO,
sorry,
as a CIO, as a chief investment officer.
no, I was just a researcher there.
Mhm. Okay.
They were pretty small, and they had their own core strategy, which was equity market neutral. They run the bulk of their risk on that side, and I came in to bring in diversifying strategies with them, that were similar in holding period, but diversifying because they were doing different things and trading in a different way. So ultimately it would improve the quality of the returns. Um, so so having joined them after they weren't active in trading futures, they just sort of hedged their equity book in futures. So we took a lot of time to sort of build out some infrastructure there. And we during that time, I spent a lot of time building out a more well-rounded portfolio strategy. So originally, I was very sort of mean reversion within an uptrend works across the board. So that was pretty consistent, apart from when you get breaks in the market. And I guess for the prior couple of years, I've been working increasingly on developing diversifying strategies, so strategies that would do well in those times of stress and crisis.
Mhm.
So then I'll build up this sort of portfolio of strategies, predominantly on the equity index side, that was very strong. And then shortly after going live there, we had the COVID hit, and we um, my strategies did very, very well. We had some sort of momentum type strategies that were looking at volatility that triggered, and we got short, very, very early in the move and rode the move down and took 20 plus 25% of out of the market on the short side. So the performance there was phenomenally good. Um, Unfortunately, though, the hedge fund struggled. Their core strategy, you know, performed in line with their peers, but it was difficult, and fundraising was difficult for the firm, and they sort of struggled to get any real sort of AUM growth, and I ended up leaving them a couple of years ago. Spent a year trading my own strategies just purely for myself, and then for the last 18 plus months, I've been working with a large institution to help them build out a proprietary trading team within their firm. And so I've been working on building out these short-term systematic strategies, predominantly on the equity index side. Performance has been very strong, and now I'm rolling that out to be able to offer similar sorts of things to other firms there as within the firm I'm building.
Mhm. You know, I was listening over I was listening your presentation, and it's pretty decent that, and it's pretty outperforming that you were in the research aspect of the business for all those time period, and you have been through, I have your LinkedIn profile open in front of my eyes, and I see all of your experiences. And next to every experience that you mentioned is like independent, systematic, micro portfolio manager, independent, 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 and it's like a motive that keeps going back over and over and over again. And for me, like, I have here some ex Citadels, ex Jane Street, ex, the largest firm. And from the largest firm going to medium and going to small firms is, I can see this differentiation. And you, it's really will find the independency in like during your career was very you know was a factor by the end of the day. And my question to you is, how easy or how hard it is to operate in that world as an independent trader, because you do have certain limitations, but you do have some certain advantages that, like, large firms cannot really embrace because of terms of agility and, terms of hierarchy. And that culture might differ, in between the two, like, and to build a dissonance that, like, could could really be challenging, could really be profitable, very rewarding. Let me know what do you think about that one.
Yeah, so that independence has been a key part of my career, and from the very beginning, that the first job I had, find a way to make money. It was sink or swim. So it was very much, that independence was ingrained then, and from the people that I started my career around, the more senior people, they were traders on the life floor. Previously, they were trading their own money, or they were trading with a firm, but they were only getting paid on performance. There was no salary. So, if you're not making any money, basically you end up leaving the industry to go and find a career that's a lot more stable. And that meritocracy there was always appealing, and the flexibility that comes with that is phenomenal when things are going well, when you've got a developed edge and the market's great. It's fantastic. I mean, for periods in my career, I've probably worked 2 hours a day, earned a very, very good living, been able to spend time with the kids, go off and do other things, and just have a great lifestyle. And then obviously on the other side, when things are hard, it's tough because you just have to double down and double down, work harder to find something that works. And sometimes that comes quicker than other times, that if it takes longer to before you find something that seems to work very consistently, the stress goes up. So there's obviously the two sides to it. It's great or it's awful. With regards to sort of the larger firms, the advantages they have, I mean, the amount of capital that gets allocated to a PM at a big shop, you can
No,
earn.
capital. I guess that capital throughout your entire career, still nowadays is a major is a major backbone because you're operating independently, and obviously those large firms constantly improve and make the market more efficient. And you, as an independent trader, or as an independent quantitative researcher, you do have some certain limitations in capital raising and procedures and my definition of independent trader is to be able to raise based on his approaches of trading the market, but it is still very, very hard to persuade, like, investors, LPs, family offices to invest within your perspective over the markets. And I think it's a major bottleneck by the end of the day. So how do you tend to resolve those situations, and how you have got very creative in solving those?
So it was kind of a completely different environment when I first started. So when I was trading within this sort of small group of traders backed by a couple of individuals, um, that was them funding me initially, and then once you built a stake, then you keep a stake in your account, and then you draw beyond there, and you get the lion's share of the profits you make. And being in that environment, there were people who went on to be phenomenally successful. Just from there, they didn't require outside capital. They end up just, if you take on outside capital, you're giving money away, which is just a waste. The edge when you are very short term is very high and isn't that scalable often. And I guess for the majority of my career, I probably only had like 50K in my trading account as a base. But you're making hundreds and thousands of percent return each year on there because the edge is high. You can turn over trades quickly. The downside can be capped. But you can't scale necessarily to the point where you're attractive to anyone with a larger amount of capital to invest. So where I've made that transition away from that sort of very active intraday trading over the last sort of 13, 14 years is to work on building a portfolio of strategies that is in this sort of 1 to 5 day holding period on average. And by building a very well-rounded portfolio of strategies, you can get something that is almost as good as in the performance as I was getting on some of the intraday edges I was working on. And by doing that and the way I've scaled things and built things, the scalability is there. So I mean, I could absolutely be running hundreds of millions on the approach that I'm running and working on now. Um, the motivation to go and work for one of those big places, having been purely independent for the entirety of my career, it just isn't the same as it might have been if I was at this point much earlier in my career. So at the moment now, I'm sort of more focused on being independent and building out an independent research firm that provides these sort of signal services, data points to institutional investors. But it is a difficult situation to make that transition from one to the other. The scale in consistency of returns are rarely the same compared to that intraday active trading when you have a more of a structural edge to the quant type research where you build these edges that are more predictive in what's about to happen over a longer time frame, which obviously then leads to being out the ability to be able to scale them. But yeah, it's an interesting situation. I mean, from my background, um, to move into one of the bigger firms, the question you always get asked is, "What's the P&L?" Well, if your P&L is not X, It doesn't matter that you've been doing it for a large number of years. By default you're at the bottom of the pile. Effectively, you don't have that credibility as
But
as they
P&L,
say.
but P&L tends like in some extent P&L might not be like the most indicative stat to look at because you have like majority different in a wide opportunity of stats that you can actually extract the understanding of what actually impacted your P&L by the end of the day. And my question is if for those firms, P&L was very, very um, was the only differentiation if you're going to win or if you're going to lose the position um, or they have looked at like other factors that might tend to be much more interesting in order to understand and in order to be able to articulate what was or how scalable the strategy is.
Yeah, I mean, I think the problem is, you have headhunters contact you, you speak to the firms occasionally, and they're in a lot of the big firms are in a very strong position where they can, there's a large supply of people that have been making good returns at other firms that are doing things probably in a way that they are more familiar with, that are strategies that they are comfortable with, because they've already been doing that sort of strategy at firm X, and they probably have someone that's doing something similar in their own firm. Whereas if my approach is reasonably different, and the way I approach things and view things, and there's that constant evolution in the sort of research I have, that it comes from sort of my background, which is unique, then
Yeah,
you
very
know,
unique.
yeah. So then the things I then come up with and build are maybe different enough that they then would require, AUM proof effectively to have the confidence to be able to make what could be a very large investment in time and money for them, and also for me. I'm at a position where that hurdle to move is quite high. So to start and build slowly somewhere puts me probably quite a long way behind where I am at the moment. So
Mhm.
that's why I was saying that maybe like 15 years ago to make that transition would have probably been a better time for me rather than now. But yeah, it's a difficult situation because, like I said, the best firms that are looking out there are attractive if you are very attractive to anyone and everyone that has got a you know P&L track record of 10 million plus a year. You can walk from one firm to another and get a better deal, outside of their non-compete periods. So, and those things are very familiar and comfortable to those firms and the BD side there.
Mhm. It's very interesting. Like, that onboarding process, which I speak about for a large extent here at the podcast, about like those firms trying to hire or trying to locate those independent traders who have developed like very very sophisticated trading systems, and they onboard them. They give them their the AOM that's needed for the system that they have been created, and this is how they can accelerate their growth. Now, with your perspective and a very wide understanding of the market in like of the market of those firms who actually trying to detect those independent quantitative researchers building sophisticated systems. I would like to understand from you how scalable is that approach is, and if is it still very viable even though nowadays to have that core of like that engine of onboarding independent traders, like the firm itself providing with the AUM and how agile it is, due to market impacts.
Yeah, so I don't really know of too many, to be perfectly honest. I've got, there's a former colleague I have from one of the firms I worked with in the past. He's a lot more active and proactive about working with a variety of other firms and providing signals to them. And that's I haven't really started sort of that work on going down that route yet. I've been too busy sort of building and running my own stuff for myself and for building stuff out for clients. But yeah, I think the the way I see it is that people are a lot more open to internalizing signals and then paying on performance based on that. But that paying on performance is a lot less clear. You don't actually know what they're doing with the signal once they've internalized it, how they're using it. So what you get paid on is not as if they've given you a book to trade. And there are people that give you a small book to trade and then will scale. But yeah, I mean, I'm not that familiar with that side of it. It's not something I've sort of expanded onto yet.
Okay, got it. So let's shift the gears onto a different topic. You have mentioned that you're strategizing for clients, and my question here is, how do you actually talk to those clients in order to understand their needs, in order to understand what are their expectations, like their limitations with their capital, and how do you actually craft a strategy that will be able to both first trade the market properly, and secondly will wrap up all those all the needs and the criteria that the clients have provided you initially when first meeting with those clients.
So, so the one particular client that I've spent the last 18 months working with, they had a set of requirements that they were looking for. They were looking to build, someone with the strategies that they could bring in fairly quickly, implement, and have an expectation that Sharpe would be like a 1.5 plus. So fairly standard for that sort of hedge fund, side. Um, and and what you're looking for is alignment with time frame, return profile type. I mean, it wouldn't be that difficult to come up with a portfolio strategies that's a 1.5 sharp that could have a negative skew. And if that's the approach they have, as long as they understand that you might have occasional outlier drawdowns, then everyone's aligned. Where I've sort of specialized is by building this portfolio of strategies. It's very diversified. I can have a hard Sharpe ratio that's higher than that and a positive skew to returns. So the Sortino is significantly higher than the Sharpe ratio. So understanding one, the time frame, the expectation that's there, the operational constraints, because in various different institutions they can be quite significant. I've worked at a firm in the past where not only did they not collect, not only could you not trade 23 hours a day, but they didn't even collect data that went for periods when the market was open outside of their office hours. So when I'm running a directional set of strategies, then a lot can happen in different time frames that have an impact on those. My strategies might have a stop or a signal that will trigger outside of those windows to sort of limit risk or take advantage of situations. And if that data is not being collected, if I can't trade during that period, then that really handicaps the approach. And you have to then find a workaround to be able to factor that in, but also understand that any workaround is going to be suboptimal. So understanding the operational constraints is really important. The alignment on sort of time frame expectations, the return profile, products that can be traded. So it's not unusual to be limited to being only able to trade a certain asset class, or futures rather than the single name equities. So those things have to be sort of factored in, and the agreement needs to be made so you're working towards what works for the client. And then those that so I'm in a very fortunate position that I'm not having to build things from scratch for clients. I've got a recipe book effectively of things that will work, and I can combine in various different ways that will give a client what they need, and give them sort of return profile that they're happy to receive. And they understand then that the various different things that are driving those signals and the performance, and what those strategies won't do, so where they won't perform well necessarily. And that is a very important part of my entire research, whether that's for myself or for clients. Is always looking about, well, where does this not perform well? The portfolio of strategies I've got, where is there a hole? What could arise? What regime shift could happen that would mean
Do
that?
you test the portfolio? How do you, okay, first of all, you structure your portfolio and then you say that, okay, you try a variety of different hypotheses in order to test your thesis, and to congregate all those factors into, a battlefield environment of testing your portfolio. And, portfolio, I would not say optimization, but portfolio testing period might be extremely challenging. And you have mentioned market regime. So, market regime, how do you test? How do you first identify a market regime, and then how do you, like, test the portfolio itself over that market regime that you have been able to detect? And obviously, you have a wide variety of different assets. So, you work with the universe? So, each universe or each asset has a very a strict definition of a market regime. So that makes it even harder to to be able to go rapidly, like, in terms of testing the portfolio itself over the same regime, over the same regime, but with different set of parameters might be extremely challenging. So the entire procedure of testing the portfolio might be extremely challenging. Now, after hypothetically building that portfolio, how do you test it across all around, and what are the factors that you're looking at? How important it is to have bigger Sortino than bigger Sharpe in order to be able to reach higher yields, and yeah, let's take it from here.
Yeah, sure. So, from the regime perspective, I mean, yeah, big picture, bull, bear, high vol, low vol. I mean, that's kind of where you were seeing things at the biggest picture. We
And in the pixel, measurement, like, how do you actually map regime
yeah.
changes, or how do you actually map the regime itself?
So, so the biggest and most obvious one that we've experienced like during my career was like the bull market in bonds that ran from like the early 80s until sort of the late 2010s, early 2020s. And so that's very easy to then, in that environment, identify that generally bonds are going one way, the price of bonds are going one way, yields is going the other way. Bonds are a great investment. They are a great part of a portfolio to put with equities because they're, for a large period of that time, they were negatively correlated. So they add a lot to a portfolio of assets. Um, uh, with regard to identifying these things, I mean, a lot of it comes down to sort of I guess the background that I've had as an independent trader, sitting there in front of screens for sort of 8, 9, 10 hours a day in, day out for like 10, 12 years. You're sitting there and watching and the market moves, seeing what the markets are reacting to. One week we might be sort of focusing on oil prices, something that's happening in the Middle East, concerns there, and how that impacts the oil price, what impact that might have on inflation going forwards, what impact that might have on the equity markets,
Mhm.
and it's identifying these little periods or these times where the market is worrying about a certain thing, and that can drive performance and that happens on a sort of very short term basis, which was a lot more relevant when I was an intraday trader. But they also happen over sort of extended periods of time on a longer term basis. We've seen inflation that wasn't a worry for 30 plus years, all of a sudden raise its head post COVID, and actually crater bond prices. So a lot of the work I do is trying to, well, one, you look at the past and you can identify these different periods where things change and move in different ways. Relationships in markets change, and that correlation between equity and bonds. flips from positive to negative to positive. So you can actually see those things, but also just look eyeballing the chart of an asset class. You can see there are periods where we are in, like for example, in the equity markets, low vol grind up, is the status quo for 80% plus of the time. And
Mhm.
it's easy to come up with strategies to do very, very well in those environments. But obviously, you take the same strategy and you apply it in those other times when we have sort of Volmageddon 2018, COVID, 2022, the tariffs side there, and those strategies just get absolutely annihilated. So a lot of what I do is to try and identify using price predominantly and relationships between different markets and like stock market breadth data to identify when things are happening that are abnormal. I mean, one of the sort of classic sort of regime identification things that people have looked at is like contango and backwardation in the VIX curve, in the futures VIX curve. And that's quite informative there. If you step aside, in one state, then you can avoid a lot of the drawdowns. And it's trying to identify lots of different versions of that and different ways of identifying things is where I spend a
You
large amount
know,
of my time.
your approach and the way you attribute those things, like in terms of regime detection, is slightly different than what I'm trying to tackle here in the podcast here, because all the quants are actually looking at a very like a very mathematic like a way to tackle things, and you are actually trying to articulate the market environment itself. So you don't really have like a non-parametric statistical measurement or any other format of mapping those regimes, but you do look at a certain market and you try to articulate the environment itself with your specialty. So like equity environment with 8% volume, or and you're just trying to explain the environment itself. And I would like to hear from you how successful that approach is, because it is slightly different than and that goes back to the initiation of the conversation. Like the independent trader, you don't really have all the infrastructure and all the capabilities, mathematical computational capabilities to map those market regimes, but you do have and you do have the experience. You do have I would say that the background to map those regimes by articulation of the environment itself. And I would like to hear from you, optimizing portfolio based on market regimes. How successful is that approach is? Because those environments change constantly, and you cannot really set a set of parameters of like the environment itself, and because the environment itself always and constantly it's been under change. So I would like to understand from you, how do you see it and how do you envision a market or a chaotic environment before setting up those set of parameters?
Yeah, so I think this is one of the the areas where I'm obviously very different from a typical quant. I don't have a scientific maths background. I don't approach the market from that point of view. I'm approaching it from the point of view of someone that that's had a trading background. So having, like I said, I spent 12 years sort of sat watching the markets day in, day out, and building that deep intuition for why markets move, what's driving them. Outside of the time I sat watching the screens, I'm thinking about markets, reading stuff online, just thinking deeper and further about things. And that's where the intuition that I've built, an understanding of where these moves come from and how we can identify these relationships, I guess, is very different from the way a quant would approach the problem. Um, I mean, you ask how successful it's been. Ultimately, it's been very, very successful. That sort of deep understanding of what drives the market has enabled me to build specific strategies that work in specific environments. So I have like various different ways of detecting a regime that is, I guess, bearish for equities, and then I've got a variety of different uncorrelated ways of identifying that. So if the move we're seeing comes out of nowhere and it isn't driven by this one factor that I've identified occurs has occurred in the past. um if it's not driven by that fear, for example, then I have other strategies that are maybe reacting to different factors that are occurring. So maybe a pickup in volatility, a pickup in the way that the VIX and the equity
But
indices
those
are moving
strategies,
together.
but those strategies have like somewhere or somewhere I would say that they have like they have data there that are not functioning not functioning anymore, and you would have to constantly craft new ideas which will be translated immediately onto new strategies like based on the new regime that have been shifted. um, and and
So
and, and yeah, what I was trying to ask here is how do you still be able to, first of all, like now after you do understand the regime, how do you still like construct those trading ideas or those strategies um, in order to like keep your performance very consistent?
so the way I guess I approach building any strategies is like a decision tree. Um,
A decision tree.
a decision tree, yeah.
It is a term that we use widely here when we
Yeah.
speak about machine learning.
Yeah. So, if I'm trying to identify a rare, bearish environment for equities and to build a strategy that works in that environment. So so the first part of the decision tree then is effectively a binary switch off and on for that identifies this regime, and then the next step might be a technical type signal that will look for, it could be a momentum signal within a in the bear on the from the in the bear market that generates short signals, and or it could be one that sort of is a mean reversion, so sells a rip in a bear market. But sitting over that is how I'm identifying the regime, and there might be a few different layers to that. I try not to cross-pollinate too much different regime ideas into too many places. So if I have, so one regime idea that was reasonably popular, a number of years ago, there was a paper that came out by, I think, Matthew Guide. It was looking at a gold lumber ratio, and was predictive of like equity returns and periods of heightened risk. And so I did some work and took it in a slightly different direction and used lumber as a signal, and it was great. And then COVID happens, and then with what's going on then with lumber is very different from and the relationship with the economy as a whole changed, and it's not as predictive as it was back in the past. Now, if I had taken that sort of lumber filter and had put it as my sole bear market filter or weak economy filter everywhere, then I've got one single point of failure. The way I approach things is continually trying to find different ways of identifying the regime from different areas. So I think I've mentioned like, cross market signals, VIX, volatility picking up in a certain way, co-movement between different markets, how that evolves and changes, confirmation between movements in different markets, market breadth, advances, decliners, new highs, new lows, the New York ticket index. That those are all really fruitful places to look for signals that can help identify these changes that are resilient. But it's the combination of looking at lots of different ones that can identify those
Mhm.
things. Plus, sometimes I have an idea that is just sort of completely unique. It's very difficult to identify, you know, well, not to identify, it's difficult to say this is doing that and this works for this reason. But actually, I've had strategies that I've built that do that, that have been very, very strong performing for the last sort of 5+ years out of sample on the long short side in both equities and in bonds that are looking at, I guess, volatility in a wider set of markets and how that is expanding and contracting. And that is the key signal within there. And then obviously within that, I then also have trend and volatility type filters just to give from the actual product that's being traded or the asset class that's being traded to give an extra layer of confirmation that uh, we're in the environment where this strategy should work.
Sure.
So that's ultimately how I'm looking at building these sort of regimes. Identify the regimes and then have a strategy that works in that regime that sits underneath that classification level.
That's brilliant. So I do want to touch on 2 points. The first point that we're going to be touching, because you're an independent activist in the market, and I would like to tackle a thing that I'm unable to tackle with someone who comes from a very well-known firm, is how do you build those strategies? Not how do you think about them, but how do you build a strategy inherently? Like, how do you, what are the most important factors you look at in the code, and how do you battle test them? Those are the 2 points that I would like to talk right now. And yeah, let's move on.
Yeah, so yeah, I'm at the situation where obviously I've got a wide range of strategies within a portfolio. So a lot of the time now I'm looking to develop a strategy that feels kind of like a specific hole in the portfolio that I might identify from, I guess, like brainstorming, like what could occur in the future that we haven't really seen in the past, what could create a different situation. And I guess like so for example, I'm good at identifying bullish and bearish environments and do strategy and come up with strategies that perform very well in those environments. But then, why I'm working, I guess, a bit more at the moment is like more of a prolonged chop environment. So we're seeing a fairly short-term choppy environment in the equity indices over the last sort of 2 or 3 months, sort of December, January, February, from 25 into 26. And we're seeing this digestion and the rotation in the market away from sort of the biggest tech names. We've got this worry about AI eating all of the software industry. So we're in this sort of prolonged choppy range, and I've had strategies that perform well and on the long and short side, which has been nice. But to now think about how I would build a strategy in a choppy environment, I would probably at that sort of regime type level, I'll be thinking about what I could, what would be the things that would occur in that choppy environment that aren't just price based in the market I'm looking to trade. So some of that might be sort of dispersion between sectors. So if they're not all moving in the same direction, that might be an indicator that we're in a choppier environment. Um, So that might be an idea I explore at that level. Does that coincide? How can I express that view that would align with environments that are then on the chart display as being choppy? So that would be how I would start to think about the idea to identify that regime, and then so that's one idea that I might look at. Then I might you know try and come up with like 5 or 10 different ideas to identify that regime in different ways. And then once I've identified these different ideas, then I will be looking to use that as a sort of a filter layer to then build
By
a
the way, when
strategy.
you're constructing a strategy or a trading idea, you're referring that over one particular asset. I'm not referring obviously to the environment itself of the market, but I'm referring to the asset itself, or you're actually referring to a wide variety of different assets. You're going to be battle test that idea over those as well.
So in the past, I've built strategies that worked across a wide range of markets, and I ran them across a wide range of markets. So much earlier in my sort of technical type trading sort of career, I built, like I mentioned, I think mean reversion within an uptrend works across the board. So I was running the same strategies without any change in sort of parameters across equity indexes, government bonds, FX futures, commodity futures. And the same idea, the same concept worked really well. And I don't do that anymore because I've increasingly specialized in building strategies that work in specific asset classes with the knowledge I have of what drives those asset classes to be able to focus in on what works in various different regimes within there. So I've specialized a lot more, and the quality of returns has increased significantly from that.
Mhm.
So I mean, it's entirely feasible to do both, but you are, I think, are leaving a lot on the table if you have the main knowledge of what moves and drives those markets. If you don't use that, you are you could be working on strategies that are significantly better. Um, so going back to the sort of the way I would look at and consider building the strategy, so identifying the regime. So I'll come up with a range of ideas for identifying the regime, and then I'll be thinking about, well, what strategies should work in that choppy, mean reverting, range bound regime. And you will be looking then, I guess, buying oversold and selling overbought. So you'd be looking maybe at like oscillator type strategies or various different ways of identifying that, or maybe on a slightly sort of, yeah. So you're looking for a sort of extreme momentum on one side to be reversed and revert to the mean. So fairly simple and simplistic approach to actually expressing the view, and then the quality then comes from, I think, the how well you're identifying that regime. Because if you take the same approach when we are in a trending environment, you're going to get ripped apart, and the strategy is going to bleed. But if you can then identify something that consistently identifies these sort of choppy range bound regimes, then you will have a strategy that has this on off switch effectively that should turn on at the right times, and then you can add that as a component into the portfolio of strategies. And then if you've got four or five of these different ideas that have um, a different filter at the top, a different way of identifying that sort of choppy regime, that's where I'll feel happy, because you're not reliant on one way of identifying a regime. Uh,
Got it.
and that's where, one, within the choppy regime, I've got a resilient portfolio, and then that goes into my existing portfolio and adds even more to it, so it's even more resilient. So that's how I would
Okay.
think about filling a hole in the portfolio, and to effectively try and build as many strategies that can complement, and that will profit in those environments.
Okay, I got it. Okay, that's a very interesting idea. At first, I would say that, like, to fit in the right strategy in the whole might be very struggling mission. Even in advance, when speaking about those terms of, of of construction of the portfolio itself. But I would like to get in depth of the strategy creation, like in the nitty-gritty that actually you take before constructing the strategy itself. So what are the considerations you're taking? How do you think of the strategy? We have spoken about that part, but how do you create the parameters? What do you look at? Let's go to the numbers itself and into the way of into the chain of thought of building that strategy in advance.
Yeah, so yeah, I'll kind of walk through the steps of how I'd think about it. So the first step would be to the identification of the regime. I'm
Yeah.
quite visual, so I quite like to see things on a chart and look at, if I'm looking at maybe an indicator that I've constructed that might look at, like I said, like say divergence within the performance of various different sectors, and how they move. So I might pull those all up on a chart and look at various different ways of looking at the spread between them and or the correlation between them. Um, because I'm quite visual, I like to see it. Do these things align with you know the this period in the market that I'm looking to build a strategy for? And then I might look at like identifying the core idea of that and how I can code that up and quantify that. And then I'm quite happy to do sort of like an in sample out of sample optimization for a parameter set to get me into the right space. So, and then I'll look at, the in sample out of sample performance. Are they similar? Should they be similar because of the split of the in sample out of sample? Do we have the same sort of kind of mix of regimes? If I'm looking for a mean reversion sort of strategy in a choppy environment, if the out sample period doesn't have any of those environments, I need to reassess where I've got the in sample out of sample split. So that will kind of put me in the right ballpark for the regime area. And then once I have that, then it will be, I've kind of got a cookbook effectively of indicators that I like to use for strategies. I quite like using the stochastic. Where are we within the last 100 bars or 250 bars or wherever, and looking at that on also on
How
indicators.
stochastic, how resilient is to look at its stochastic indicators and to, derive the conclusion out of, looking at the stochastic, like stochastic or even random occasions that you can derive out of the stochastic indicator.
Um, so I'm a big fan of like the in sample out of sample optimization. You leaving that out of sample period there is if you are sensible with how you make that split, that you have a sort of a diversity of ranges there. I'm quite happy to do that sort of optimization. Stochastic is on even on indicators that so you've got some sort of universal way of looking at anything and everything is kind of my default layer of looking at things to see how they are compared to where they are in the past. I found it very useful, and that the all of the strategies I've built have gone through that kind of research process where that in sample period you're checking the out of sample period, and it's not so much torturing the data, it's just sort of pointing you in the right direction. And then, like I said, I'm quite visual, so I want to see the chart, see where the trades line up on the chart. Is it doing what it should do in the right environment? And if it isn't, the parameter set that might look great from the optimization might not be doing what I want the strategy to do. In which case, I might save that, set it aside, come back to it at another point. But then I would sort of go back through it and put in, so, or maybe try and really focus down on making sure the strategy is doing what I want the strategy to do at the times I want it to do. So that's I'm constructing a strategy to do what I exactly what I want it to do when I want it to do it. If it's not doing that, that's not the strategy I'm trying to build. So that the optimization process is really to try and get to that point, and then the out sample period. Is it still identifying those periods? Is it still doing what it should be doing? And at that stage, then if it is, then that's great. You can put it into sort of incubation, track it,
For
follow it. Uh,
for how long do you live the strategy on out of sample periods in order to, have a concrete understanding of if the strategy is enough resilient or not?
so It depends. If it's an intraday strategy that trades a lot, it can be a matter of weeks before I've got enough confidence to be able to actually implement it in live trading. For some of them, it can be weeks and months. I've got strategies I've sat there and I've been tracking for years, but and they've performed well, but I don't actually implement because one, it's not really a market I trade, or I don't have any use for it, whether for the work in the way I'm trading at the moment. So you know, pretty much everything I'm trading now has had a very extensive out of like live trading track record going forwards. Um, and which is great. You know, I've got a strategy that I trade now that I built 15 plus years ago that it's had minimal adjustments to that still performs very, very well year in, year out. Um, I think one of the things that's um, improved significantly over time is my hit rate on strategies that work and continue to work has increased significantly.
Really?
Um, yeah,
Which
and
is
some of
which is the complete difference than like the average or the regular quant comes here to speak. Like
yeah,
the measurement of alpha decay is like tends to be like in a matter of because the market gets to be very much efficient and we don't it really depends on the overview of the firm, but going for already established markets and trying to find an efficiency there or a reliable trading strategy that can work with a pretty decent amount of capital. Like the alpha decay could be in a measure in a measure of weeks till a few months, and that's it. You have completely ended up that strategy. You cannot deploy it over live trading. And you say the complete opposite. You say, okay, now I build a trading strategy. I know exactly how it works, and eventually your hit rate like increases over the years because the strategy still remains very reliable. So, and I guess they use still trade established markets. So I would like to ask you, how do you see this differentiation? Because your perspective is very much unique than the perspective that we present here. And I would like to ask you, how can you still maintain that heat rate and even duplicate that success over more strategies under the understanding of the type of the regime that we're in.
yeah. So I mean, just to be clear, I think when I mentioned hit rate, I think that's the hit rate of me building strategies that work
Yeah,
out
the
sample.
intuition.
And I think that's by virtue of me improving in the research that I do, the quality of the ideas that I'm coming up with, because I'm thinking about the markets a very large amount of the time once I'm sitting down and working, but also outside of that. So there's a lot of filtering that goes on, and I also have a lot of experience of what has worked and what works in other areas. So I I'm not starting this afresh. I've got 20 years, 21 years now of building systematic strategies, experience that has sort of led to this point. And so that filtering, I guess, of ideas is the key part. Where I think probably the people that you've spoken to that have strategies that almost get to a point where they can't implement it before the edge goes, you're probably talking more people about who are identifying more of a structural edge in the market or identify maybe on a higher frequency basis, maybe a specific market participant that's behaving in a certain way that they can take the other side of effectively or identify a front run. And those things, there are a lot of people trying to identify those things and react to them as quickly as possible. That's kind of a very different playing field from what I'm working on. My prediction field is sort of 1 to probably 20 days, with the average of probably like 2, 3, 4 day holding period on across the portfolio strategies I've got. So it's very different, I guess, where the edge is not as clear cut, but is probably more resilient because of that. And I guess they're both very hard to do that sort of edge identification where there's a structural reason for it, and also an edge identification where I'm identifying all of these leading indicators that suggest this is going to happen, um, and then it does happen consistently and repeatably. They're very different things, and there's probably a lot more people focused on that higher edge structural side because the quality of returns is magnitudes higher than what I generate on maybe one individual strategy. I have strategies that are probably sub one chart, but they do something very specific to a portfolio. But I might have a portfolio of strategies that has a Sharpe of four. So and is scalable because of the way it can scale in and out of positions over time and the holding period it has. So they are different playing fields effectively, and one is a lot more competitive than the other, I think. That is probably
Mhm.
why they're the things that they are seeing get arbitraged away sooner.
Mhm. I got it. And your type of actual building strategies might be struggling in a sense, or might be very rewarding in raising capital. Now, obviously, we have already spoken about that, but right now, after that conversation, I do ask myself. Okay, hey, I see now as Rob's perspective over alpha extraction and alpha generation. And I'm very, very curious in order to understand how easy it is, or how approachable it is to attract from a very unique profiles to invest within the firm that you're building or you're offering them.
Um, well, my experience is it's very difficult from my background doing the things I do to break into you know the established you know large firms. Um, One, because there's not the big name on the CV that I haven't done it at, Citadel, Millennium, or whatever. And two, I can't point to 10 million a year plus P&L that's mine in a way that I could have done if I was working for one of these bigger firms. So it's kind of like a catch-22. What comes first, chicken or the egg? You can't get the track record, because you haven't got the track record. So where'd you get the track record? So that's where I'm sort of trying to, you know, go in a different direction. And, I see the value of not just the react immediately to the trading signals I get, where you can get very, very strong performance, but also slowing that down, smoothing that down. There are signals that are still very, very strong, that are still very, very strong performance, but they will be really attractive to investment managers and pension funds and people that a sharper one is incredible if I can offer them signals that are sharper one and a half, two, on a time frame where they have to make trading decisions that they are comfortable with. That is something that they could be very interested in. And that's where I'm sort of looking to branch out now and offer that as a service, alpha as a service, effectively, to clients in a different way where I don't have to point to that's my track record at that firm as evidence. I can provide signals for people on a walk forward basis that they can then be comfortable with across various different asset classes, whether that's gold, fixed income, equity indices, whatever, which is where the sort of my sort of greatest strength is. So yeah, so given the constraints of my background and things like that, I'm trying to effectively build this firm in a way that can help the most people, without that sort of holding me back.
That's a very interesting approach. I would have to admit, very, very creative one. Okay. Let's go back over the optimization of the training strategy and the auto sample, the in sample auto sample approach. You have mentioned work forward, which is the thing that I would like to dive deep into with you. Um, you said that you're a big fan of in sample and auto sample. Why?
I mean, the dream situation is you can use a walk forward optimization where you are constantly adjusting to what's gone on in the past. But I think what I mentioned in the past, when I'm doing the sort of the optimization, I'm not always choosing the best results. I'm choosing, the parameter set that gives me the signals when I think the signals should occur. So that's a very difficult situation to be able to approach in a sort of a more automated walk forward approach. I mean, without my intuition and understanding, being able to quantify that, then I can't approach it walk forward in that way, which is why I've never been able to sort of actually go through that approach. But that my view is if I'm trying to identify a regime X and strategies that perform well in that regime, and I'm using an in sample out of sample split to find parameters that perform well, whether that's the filter at the filter level for the regime and then the actual core trading logic that within that regime, I have a lot more confidence that an in sample out of sample split of me identifying the parameter set that's not the highest returns, but the ones that give me the returns when this when I know that this regime is in place. And it's for example, if it's a strategy on the short side and it doesn't make money during COVID and it doesn't make money in 2022 and it doesn't make money in 2018, but it makes money on a random other years on the short side, that's not really the parameter set that's given me what I want the strategy to do. So I'll go back to the drawing board and end up in a different sort of parameter space that is actually identifying the trades that I want the strategy to do. Um, and then with that in the in sample, then you can check the out of sample. Is the out of sample then performance? Again, is it giving me the signals when it should do? And you know, I'm not naive enough to think that every filter with one set of parameters and one and set of trading rules with one set of parameters is give me everything. And that's where I said before, if I'm looking at something that's this kind of like mean reverting, choppy regime, I ideally want four, five, six different strategies that will do well in that environment that are all different and different implementations that are then a lot more resilient going forwards and performing there. So I might have missed, Volmageddon on the short side, but if I caught the Q4 sell-off in 2018 and I caught, all of the other sell-offs since, that's great. So you don't expect everything to work every single time, but if you add enough together that do things in a different way, you should be catching enough of these, all, you should be catching every one of them in some way. And that's the way I'm looking to sort of build a portfolio of strategies effectively.
Very interesting. Um, Okay, so we have gone through many topics from strategy construction, regime understanding, regime market environments, in some plot of sample, fund managing, like fundraising procedures and everything. And I do like to ask you one last thing before we go is after a very wide experience in the markets. How do you right now leverage your experience onto building your next projects? Because I do think and I do feel like that you have absorbed so many over the years, like naturally, and leveraging leveraging properly and in the rightest way your experience is an art is the art of of everyone who actually wants to leverage to leverage your experience and you to me sounds like a very art like an art in what he does, and I like to understand how do you leverage your experience over your day-to-day job, and how do you think about it, and how do you you know uh, trying to dissolve the situation with growing up your experience on top of it.
Yeah, so the first and foremost is, what's been the key driver throughout everything is that interest and the passion in the markets and understanding what's going on and why. I'm naturally curious. I want to know about it. I spend far too much time thinking about it ultimately, but it's that interest that sort of stimulates the research process, the ongoing side, like, oh, I want to test this, I want to try that, I want to do that. And then, you kind of have to balance that with the needs of, you know, delivering, the things that the clients need, trying to then formulate how I want to build the business, where I want to angle that, and move towards, and who the clients for that could be. So it's just an ongoing process, and it's I always fall back into I'll do some more research because that's what I find enjoyable, and the sort of stimulation comes. So the balance has to come in, and you have to be disciplined with yourself and think, well, actually, no, I need to make progress on this, and walk and get towards the longer term goal of what I'm trying to build. Um, but yeah, I mean, the key to it is, I think, if you're passionate and hungry and interested, those things are going to lead you in good directions, generally in life. So,
Mhm. Absolutely. So, Rob, I would love to thank you for your time and for your participation. For me, I said I was constantly repeating that that episode is slightly different than what I'm really like to speak about. But it is I think that your perspective that you have shared with us today is more than important, and we would have to absorb many of the things that we have spoken about today in today's session. And I would really like to thank you for your participation. It was a pleasure for me to have you, and yeah, thank you for coming.
it's my pleasure. Thank you for having me on. Enjoyed it. Thank you.